Hello and welcome to Switzer Super TV. I'm Peter Switzer. This is my colleague Paul Rickard. Hi Paul.
Hi Peter.
Well, the banks, they've had a bit of trouble in big banking world over the last few weeks, and they've been blamed for the market going down. So what's the true story?
Well, they have had a bit of a rough trot, Peter. The banks have lost about 8.5% since the start of April. The market's down about 4%. So underperformance around about 4 to 5%. But the banks have been great performers, and it's worthwhile just bearing what's happened over the last 5 years, particularly if you look at this chart on the screen in front of you, the banks in green and the S&P ASX 200 in blue. And you see the banks have really been stellar performers, but certainly over that gap has started to close.
Yeah, so it's always a matter of time before something like this might happen. But I guess there are three reasons. Let's just work our way through the reasons for the banks copying it.
Yeah, really three reasons. The first one is capital, Peter. Since, of course, the David Murray's Financial Systems Inquiry recommending the banks hold more capital, that's been very much top of mind in the marketplace. Interesting enough, Peter, each of the banks has started to actually to increase their capital base. On the screen in front of you, you can see the different things the major banks are doing. So, for example, the ANZ Bank has announced its intention to sell some minority stakes in some of its Asian banks, plus Sanda Finance. The Commonwealth Bank, it's having a dividend reinvestment plan. It wasn't neutralised, which means that those shares weren't then repurchased back in the market. National Australia Bank announced amongst them a very comprehensive plan to raise capital, a 2 for 25 rights issue to raise $5.5 billion. And Westpac announced a partially underwritten dividend reinvestment plan that will raise around $2 billion. So each of the banks is taking steps to boost its capital base. And of course, if you issue more shares, that's dilutive, and potentially that means prices come down a little bit.
Okay, and the bond market's been a little bit crazy lately.
Yeah, that's been the one a little bit out of left field. We've seen bond yields across the globe go higher, the yield curve steepen. In the US, for example, bond rates have risen to more than 20 basis points over the last month to about 2.15%. In Germany, they've come off just crazy levels up to about 0.6%. And in Australia, we've risen by about 40 basis points to, or 0.4% to about 2.85%. Now, what's the relationship between bond yields and banks?
Exactly my question.
Well, banks are sort of a bit like annuity sort of income streams in many cases. And of course, if bonds become more attractive with the yields going up, then that obviously puts some pressure on bank share prices. They need to come down a little bit to make their yields more attractive. Also, the bond market is potentially signalling, Peter, that we've seen the bottom in interest rates.
Which is not a bad thing. Let's go now to the third and important part of the story, the fact that earnings haven't been great.
Yeah, and on top of that, last week, I think the other trigger, of course, was that three of the major banks had half-year profit announcements. The Commonwealth Bank had a quarterly results announcement. They were all along a little bit disappointing. I think there were probably two messages. There was almost, revenue growth is almost non-existent. But more importantly, earnings growth has largely stalled. So for bank shareholders looking at those
Joining us on Switzer Super TV.